What does the government do? They come in, they impose a tax to get you to need the state's money. The government can then spend the currency into your hands to buy goods and services from you. They spend it into existence every time they make payments. They don't even need to do what we would normally call borrowing, selling bonds. They don't even need to do that. When they do choose to do that, they sell a bond that promises to pay you currency later, something they create from thin air. And so that is an incredibly easy promise for them to keep. And so it doesn't make much sense for lenders to start saying, oh, the debt's getting really high. Maybe I'm worried about this. Maybe they can't keep this promise. All they're promising you is numbers on a spreadsheet that's on their computer. The idea that lenders would get worried that the government can't repay and start refusing to buy bonds or charging a higher interest rate doesn't make sense.
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, which I've linked to in the show notes, along with some other things that relate to this particular episode. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes where you can ask me and Patricia MMT questions. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. A big thank you to all of our supporters so far, and thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley.
And I'm Patricia Pino.
And it's our pleasure as ever to welcome back to the show MMT scholar and Deficit Owl Sam Levey. Sam, how are you?
I am good. Thank you for having me. How are you guys?
I've got a really sore throat, as everybody can hear. And I think Patricia's reeling from her booster jab as well. So this is going to be high octane stuff. so let's get
with the sniffles.
Yeah, exactly. So let's get right into it. Paul Krugman has been straw manning MMT again. Business Insider had this article entitled "Paul Krugman Explains Why He's More Left-Wing Than the Modern Monetary Theory Crowd." And then the article goes on to say that Krugman thinks he's to the left of MMT because he thinks monetary policy works. Quoting from the article, Krugman believes policymakers can rely on the Fed to keep price growth in check. Quote, followers of MMT then can be more cautious and less willing to go wholeheartedly into progressive policies, according to Krugman, than those who appreciate the Fed's power. So, Sam, what's your reaction to that?
This is one of those things that is like such intense Orwellian doublespeak, that I think when I read that and my reaction on Twitter was like, do words even mean anything anymore? Because, and first of all, I'll say that there's a popular view of MMT that I more or less agree with, which is that MMT is not necessarily partisan, right? And I think Scott Ferguson likes to say it's political, but it doesn't have to be partisan, right? Like there are conservative MMTers and there are progressive MMTers and left and right wing. And there's different things that different people of different political persuasions can get out of MMT. And I think that's absolutely true. But for those of us who are coming to MMT from the left, right, this thing from Krugman is just total nonsense. I mean, so the logic again is that he's saying, okay, well, the MMTers don't think that interest rate policy works. They don't think that, we can depend on the central banks to raise interest rates to, halt inflationary pressure or whatever. And that's true. We've said for a long time that we're not super confident in the ability of interest rate fine tuning to manage the economy in that kind of way. That doesn't mean we are against all things that you would call monetary policy, and maybe I'll come back to that in a second. But that part is true. But then so Krugman says, oh, well, that must mean that I, as a person who does support interest rate policy, does support the Fed, that means I can support bigger government deficits, and that's more progressive. The government can spend more or whatever, and do more public spending, more benefit programs and stuff. And if it starts to cause inflation, well, then the Fed can jump in here. Whereas if I were an MMTer, Krugman says, then because I don't believe in the Fed or whatever, they can't jump in. And so there's nobody to save us. So we'd have to run smaller deficits, right? The MMTers, he says, think we got to use taxes or something, or cuts to government spending to control inflation. So that's Krugman's argument, which of course, very few parts of that are correct. So first of all, the idea that MMT only thinks we should use fiscal policy to regulate aggregate demand is not true. We've said for a long time, everything should be on the table, right? I mean, even interest rate changes, there are times when maybe you'd want to use that. We're not too keen on those, but just any kind of tool, economic tool at our disposal should be on the table. It should depend on the circumstance, right? What's causing the inflation, what the political realities are, right? There shouldn't be like a single go-to, oh yeah, that's the silver bullet every time, right? So we don't think like that, right? And part of this maybe is you can attribute to some of our bad messaging in the past. We like to say taxes function to prevent inflation, right? And I like to try to clarify to people when we're saying that is not a policy recommendation, right? That is not saying we should use tax rate adjustments in real time to try to regulate the economy month by month or something. All that's a statement of fact. Taxes function to prevent inflation.
Would it be fair to say, Sam, I often say, taxes function to regulate aggregate demand. Is that, that they have to do that?
Yeah, exactly. If the taxes weren't there, what would be happening? Aggregate demand would be much higher. We'd have a huge inflation, hyperinflation even, right? If we just cut taxes to zero tomorrow. So it's a statement of fact. Taxes are regulating aggregate demand. They are preventing inflation, right? It's not the same thing as saying we got to start adjusting tax rates every couple of weeks to fine tune this thing, right? Those are totally different. So that's one misunderstanding that, we should maybe be a little bit clearer on. But, then again, we've been saying this for years to Krugman, and he still hasn't figured it out, whether by intention or not, I can't say.
Well, yeah. I think that the one thing that was notoriously absent from this article is he didn't mention the job guarantee. And I think that the reason why he doesn't mention that, even though it's like the only policy prescription of MMT, say, is that, once you accept monetary policy, and tell me if I'm looking at this the right way, but once you accept monetary policy, you also necessarily kind of underestimate the output gap. Whereas, because you're sort of accepting that some level of unemployment will be inevitable. Whereas MMT, on the contrary, basically says unemployment is a policy failure. So the output gap that the MMTs predict would be much higher. So he doesn't mention any of that. But that kind of interpretation of MMT then leads to saying, okay, there's a lot that the government could be doing here that it isn't doing.
Yeah, you are 100% correct. And that's a great point, which is like, okay, this basic idea that everyone agrees on is that if demand for goods and services is too high, it's probably going to start driving up prices, and the microeconomics of that get a little hairy or whatever. But as the short version, everyone agrees when demand is too high, prices are liable to start going up, right? Now, it's definitely not true that demand can be like exactly the same in all markets all the time, right? If we start increasing demand, we're going to, in different, just in general in the economy, then different sectors are going to start running into problems sooner than others, right? Like right now we've had the lumber issue, right? And we've had the semiconductor issue, right? And we've had these like specific supply and the meat issue that you are maybe hearing about, the ransomware thing. We've had like specific issues in specific sectors, right? Whereas some other sectors maybe like don't have certain supply issues. And so there's room to raise demand in those sectors, right? So if we just start indiscriminately raising demand, we're going to hit problems in some areas before others, some sectors and industries before others, right? And that's liable to start driving up prices and causing inflation before we've really like wrung all the slack out of the economy, right? Before every last person who wants a job can find one, right? And so you're absolutely right. For them, if they define full employment as we just keep raising demand until inflation happens, and then when inflation picks up, well, that must have been full employment, right? Then they're going to have us stop way short than the job guarantee approach, which says we're at full employment when every single person who wants to work can work, right? That is going to employ everybody. Whereas the other approach, which is the NAIRU approach, is going to lead to, millions of people, some number of millions of people, 3 to 6 or something % of the workforce at least being unemployed when they start saying, hey, we're at full employment.
Just to critique the article just a little bit further. Yeah, exactly as you two say, the article does this thing that happens all the time to MMT. The article describes MMT by saying, quote, where the prevailing policy strategy sees budget deficits as the primary obstacle to spending, MMT asserts that inflation is the biggest risk. Next sentence, taxes can then be used to slow inflation by reining in the money supply according to the theory. So I just want to stamp on that and just say they're misrepresenting MMT in that opening paragraph. So I'll just say for the record, MMT and logic argues that the government deficit equals the non-government surplus. So far from being an obstacle to spending, government deficits are actually the non-government's spending money. so there's that. And then it also sets up this other straw man that MMT says you're supposed to spend until you get inflation and then tax to curb inflation, just as you said, Sam. And that's not the case, and because then that opens the door to people going, well, how can we trust the government to raise taxes? We need to, they're clunky, they won't do it, they're corrupt, they won't, raising taxes is unpopular. But so again, for the record, the only policy in MMT is the job guarantee, counter-cyclical, automatic stabilizer. It's just better than the automatic stabilizer we use now. We're swapping involuntary unemployment for guaranteed true full employment to create price stability. I don't think I've said anything controversial there.
No, I think you're spot on. And there's one more thing I want to say about that article, because when Krugman is saying, hey, we can just run in my view, Krugman's view, we can run bigger deficits because we can just raise interest rates when inflation becomes a problem. And so that's more progressive somehow. Well, he's having it both ways there, right? He's looking at, bigger deficits, that's progressive. He's not asking whether or not the Fed raising rates to control inflation is progressive or not. And, are higher interest rates progressive? Well, I don't think so. I mean, what happens when you raise interest rates, right? Then borrowers, the interest rate they pay goes up. Lenders, the interest rate they earn goes up. So you're transferring income from borrowers to lenders, right? And who are lenders and who are borrowers in our economy these days, right? It's not really progressive, I think, to say we should increase the income of the top 1% by a lot, right? He just ignores that conveniently, right? So, I mean, this is one of the reasons that we're against raising interest rates to control inflation, because it's regressive.
Yeah.
Why do we think that our friend Mr. Krugman does this? Because he it's quite confusing, because he keeps changing his position. One day he seems to understand some aspects of MMT or kind of even side with some aspects of MMT, and then the next he's doing things like this.
Well, now I'm just going to be fair to Krugman now, which is, apart from the headline, that the only time the article frames Krugman as critiquing MMT is that quote that I just laid out. The rest of the article is about how Krugman is worried that policymakers will make the same mistake as they made in 2008, i.e. not making the deficit big enough to counter the crisis in the name of so-called fiscal responsibility, which I would say is actually an MMT position. So I think what we're seeing there is what it looks like when a famous commentator has to admit MMT is right, but has already carved out a public persona as the guy who says MMT is wrong. So he's, like you say, he's trying to have it both ways, but he, implicitly admitting that was the problem in 2008, which was exactly what the headline MMTers were saying. But, at the end of that decade and all the way up until now. And so, in some ways, it's a partial victory for MMT.
Yeah, I don't like to speculate on what's going on in other people's heads too much, at least not publicly. But all I'll say is that, all the changes that have happened over the years on the MMTers and with Krugman's been moving towards us, not the other way around. So
sure. Yeah. So there are still commentators out there, and I linked you guys to something from Naked Capitalism, there are commentators out there who still feel that very low interest rates or ZIRP, zero interest rate policy, is regressive, and that it deepens income inequality by increasing the total share of income going to the top cohorts. What do you say to that, Sam? Let's start with you.
All right. Well, to say that it increases income going to the top is almost certainly wrong. Because again, interest rates are the income, right? Interest payments that you have to pay every month on your car loan or your student loans or your mortgage or whatever, that's the income aspect of it. And so lower interest means less income for those people on those assets that they hold that are now paying them less interest, right? And conversely, for borrowers, they have to pay less interest. So that's more of their income that they can keep. And borrowers tend to be lower income people, right? So on the income side of it, I think that's wrong, that lower interest rates are actually more progressive. Again, this goes all the way back to Keynes and the slogan, euthanize the rentier. Rentiers, people earning rents, people with unearned income, we might say, income that in some cases at least doesn't serve any social function and isn't earned. So euthanize the rentier, lower interest rates towards zero, get rid of those people's unearned income, at least in some cases unearned. So on the income side of it, lower interest rates are progressive, right? But there is another side of it that is worth talking and thinking about, which is the wealth side. So again, income, something you earn every month or every week or whatever, or every quarter. Wealth, the stock of assets that you hold on your portfolio, right? And there tends to be this inverse correlation, inverse link between interest rates and wealth, in that when interest rates go down, asset prices tend to go up. The value of assets goes up. So if you're holding that, then your wealth has just gone up if your asset has increased in value. Are you guys familiar with this inverse link between interest rates and asset prices?
So with regards to that, there is a narrative that has been quite popular, I think, since the crisis, since the 2008 financial crash, and that is that, well, the role that low interest rates had on that, and I think it's sometimes an oversimplification to say that low interest rates cause, just specifically about the housing prices, because often when people talk about asset prices, that's what they're mostly concerned about. And I think that a lot of the issues, the shortages with regards to housing have to do with, to be honest, to a great extent, to the use of monetary policy and the fact that investment is concentrated into some certain areas, and therefore there's been kind of massive kind of movements of labor from rural areas into the cities, and that has driven the house prices up, alongside other factors, right? Like the very fact that we use property as something to be exchanged, as a good. I know, for example, in Australia, they have more strict laws than we have about who can buy houses, and I wouldn't see an issue, for example, with restricting the number of properties that you can buy. We have no such thing in the UK. In the UK, properties are just a savings account to a lot of people. And then, people come in and say, oh yeah, it's just low interest rates. Well, not really. I mean, there are so many other factors and so many other things that we could use to restrict, to improve on housing prices without going into the interest rate and without having to say, oh, sorry, if we don't give rich people a free way to make money, then they're just going to put that into the housing market. What do you think about that?
Yeah, there is this sort of general link between interest rates and asset prices, in that lower interest rates tends to mean higher asset prices. And I don't really study housing, and I don't really know that much about how it plays out in housing. I think it's almost certainly true that the link is weaker in housing than with like bonds. There's a really tight link between the price of bonds and the interest rate. On the other hand, I would be surprised if there weren't some link, especially because, as you say, with more people using houses as a savings account, well, then they care more about the return, right? Like if I'm buying a house to live in, then I don't care. I'm not going to buy, the interest rate might affect how much I can borrow to buy the house, but it's not going to affect, I'm not thinking like, oh, the return that I would earn from buying this house is like higher or lower than the market interest rate, so I'm going to blah, blah, blah. Like they're not thinking like that if you want to live there. But on the other hand, if you're buying a house just to own it as an asset and rent it out and earn rental income, then you might be looking at like, okay, how much does this house cost and how much is the income? And so what kind of interest rate is that? And so you might be looking at, so the more that housing is this very highly commodified kind of market where people treat it as a financial savings vehicle as opposed to something that they live in, then I can imagine that would strengthen the link between house prices and interest rates. But again, I haven't really looked into this that much. It's not my area. But either way, I absolutely agree with you. Even if it's true, raising interest rates is not the way to deal with the housing price problem, right?
Yeah.
I mean, the obvious solution, I think, is exactly what you said, is to have people stop treating houses as financial savings vehicles and instead treat them as, residential, the home you own or the home you live in, right? And at one point I did look and in my city, the fastest buyer of housing is actually foreign financial institutions, right? To me, that's not good, right? That foreign banks are the people who are buying up all the houses in my city, and that's making it harder and harder for just residents who have lived here all their lives to afford to live here, right? Like, that's the problem to me. And the solution, I don't think, is pay them more on their bonds so that they'll stop buying houses, right? That's like, we shouldn't be bribing the rich to give us a place to live.
Yeah, that's exactly the words I was going to use. We should not be, it's blackmail. We have zero interest rates now, or close to. And, people are only sort of pointing at ZIRP now and blaming it for things because we've come down to ZIRP. And of course, the natural interest rate on dollars or pounds or yen is zero. The government has to intervene to make it be above zero. So it's like, I think it should be a left-wing thing and a right-wing thing. It's like, if you're against government intervention, ZIRP is the way to go. And but also if you're against the rentier, ZIRP is the way to go. That's what we need.
I think it's the reason it's not a right-wing thing is because the right wing is hesitant. Hesitance maybe not strong enough of a word, but it doesn't want to ask questions about how society is like foundational to all these things that exist out there in the markets, right? Like, doesn't want to ask how government has built markets, doesn't want to ask about how government structures the currency and those kinds of issues, wants to see it as something that emanates from private individuals that they build themselves, and then the government comes in afterwards and screws it up, right? Doesn't want to see government as the foundation of some of this stuff. And the story you just told about the natural interest rate being zero, this kind of an MMT way of putting it, the story there starts with the government. The government comes in first, creates this system, and that system has this tendency for interest rates to be zero. And if the government doesn't want that, then they have to come in and do something else to get a higher interest rate. And the people on the right don't want to admit the first premise, right? They don't want to admit that the government is foundational for economy, right? For them, they want the government to be this thing that comes in afterwards and mucks up the economy.
With regards to other assets, we're thinking about corporate bonds and stocks, but as well, the assets are quite different. You could also consider artwork to be an asset. And we know that the last few decades, the art market has just gone absolutely to insane levels of prices for artworks. And that has a cultural impact in the sense that it makes life very difficult for museums that are free to obtain the artworks that they need for public and more and more dependent on the donations of rich people who hold most of these artworks, etc. So that's a huge story and probably for another day. But I guess the question is that link of the interest rates and assets going up has also, I've observed, just observing the prices of artworks over the last few decades, that has been assigned largely to the increase in inequality. And just the very notion that there is awful lot of rich people out there with a lot of money and they literally do not know what to do with it. To me, that seems to be more of an issue for inflating asset prices than anything else. What do you think?
Yeah, no, I'm inclined to agree. I think you're right.
So raising interest rates, if anything, is just going to make that worse.
It could. Again, it cuts both ways. This wealth and income thing go in opposite directions. You raise interest rates, their income goes up, but you raise interest rates and then the price of some of these assets falls, so then their wealth goes down, right? But now the really important difference is that income is an ongoing thing. You earn income every interest payment, every quarter or every 6 months, whatever it is, how often the assets pay, whereas the wealth thing happens exactly one time, right? When we cut interest rates, asset prices go up, so the wealth in your portfolio goes up once, and then your income is now lower for as long as interest rates stay low.
Yeah, good point. So moving on, in terms of misinformation over here in the UK, we had a piece in Market Watch last week entitled "The Government Feared Bond Market Meltdown from COVID-19." And this came from some testimony that Dominic Cummings, who's Boris Johnson's previous advisor, gave. And in it, he claimed that, quote, the Bank of England, the Treasury and senior officials in the government were worried that if we have a lockdown, the government are going to have to borrow huge amounts of money. And the concern in these circles that he's describing was, quote, what if the bond markets suddenly spike and go crazy and refuse to lend to us? And I'm asking a leading question here, but why does that show a lack of understanding about how governments spend and the function of government bonds? I'll throw that over to you, Sam, first.
Yeah, sure. Well, I mean, let me preface this by saying I'm not an expert on the exact nuances of the UK system, right? And I do remember reading a paper maybe a year or two back. You guys might know what paper I'm talking about. That did detail from an MMT perspective, like exactly how the UK system works with a consolidated fund and those kinds of things. Do you know what I'm talking about?
Yeah. We interviewed the authors of the paper. Yeah. It's called An Accounting Model of the UK Exchequer, and it's by, for any listeners, it's by Richard Tye, Neil Wilson, and Andrew Barclay, that's it. Yeah. And but anyway, you could listen to our episode with that. It's roundabout. It's one of the around about episode 90, and we did a two-parter with them, but that's the name of the paper, and it's on the Gower Initiative for Modern Money Studies website, the GIMS website. So we'll link to that in the show notes. But yeah, they did all the FOIA requests and they ran up against all kinds of resistance, but they did the nuts and bolts at the granular level, just getting into which channel hooks up to which channel and how the spending happens. And it's to cut a long story short, it's, as MMT says, the government vote money into existence. The votes are the thing that makes the spending happen.
Yeah. So, you can answer these kinds of questions on two levels, right? The first level is the sort of more abstract, like, what is the purpose of this whole system and what is it designed to do, right? And then the second is sort of the more in-depth or detailed, aspect of like, what are the very concrete, building blocks, and how do the institutions and who are the people and what are their roles and how do they all collectively work together to make this whole system do what it's supposed to do, right? So for the first question, the more abstract, high-level view, right? The mainstream has a view that oddly enough, ironically, and maybe we'll get into this again a little later, but ironically treats money as kind of special. Money is this thing that's kind of special, and it can be created or whatever, and it can be destroyed, but it's money. And then the government, right? They're just like any other household in terms of their budget. It's true they can create and destroy money, but we try to sequester that away from them. We give that power to an independent central bank, so the state doesn't really have anything to do with it. It's the Monetary Policy Committee making their own decisions or whatever. And then that renders the state just like a household. They borrow and they spend, and they don't work very much. They collect taxes instead, but they get money from somewhere and then they spend it. And so for that, from you coming at it from that point of view, then first of all, those nuances don't actually matter. The like detailed structure of the thing, you don't care, right? Because you've got the story, and the story doesn't depend on what's going on at the lower levels, really. But also, then you run risks of worrying about default, because you're saying, hey, well, the government's got to get the money. What if they can't get the money, right? It's a problem. And, and especially you'd be thinking, well, at high levels of debt, what happens to a household? Well, if your debt gets really high, then the lenders start to get worried, like, hey, you're not going to be able to pay this debt. And so maybe I won't lend to you, or maybe I'll lend to you, but I'll demand a much higher interest rate to compensate me for this risk of you not being able to pay back the loan or whatever. So, household debt, it tends to get bigger. Interest rates on the debt tend to go up, right? That's why people get like these predatory loans and stuff. Okay, so that's the mainstream high-level story of what's going on, and that's where these fears come from. The MMT story of what's going on, again, ironically, doesn't treat money as special. It treats money as just another kind of IOU, and when the state spends, it's writing IOUs. Okay, so how, we've been over this, I think, us, and then I'm sure your listeners have heard this hundreds of times by now, but the basic tax-driven money story, right? What does the government do? They come in, they impose a tax. The tax is to get you to need the state's money, to get you to need currency, so that the government can then spend the currency into your hands to buy goods and services from you. Now you have the currency, you can pay the tax. So what the state was trying to do was get the goods and services. They use the money as like an intermediary process. They write IOUs to you to get the goods and services from you, and then you use the IOUs to pay the tax. That redeems the IOUs. They're gone and they're destroyed. You do that, right, when you pay your tax. That's the MMT money story and the high-level picture of what's going on here. So from the MMT frame, first of all, there's no natural reason to worry about defaulting on your debt or interest rates going up or whatever. Well, why not? Well, because first of all, obviously, they create the money. They spend it into existence every time they make payments. And so, they're not going to be able to not do that. So first of all, they don't even need to do what we would normally call borrowing money, right? Selling bonds. They don't even need to do that. It doesn't necessarily serve a purpose in that little loop I just described of the government getting goods and services. So they don't need to do that, right? When they do choose to do that, though, they sell a bond that promises to pay you currency later, right? The promise on that bond is that they'll pay you currency. Currency is something they create from thin air. And so that is an incredibly easy promise for them to keep, right? It's true that they're making promises, but they're making promises that are really, really easy to keep. And so it doesn't make much sense for lenders to start saying, oh, the debt's getting really high. Maybe I'm worried about this. Maybe they can't keep this promise, because all they're promising you is numbers on a spreadsheet, right? That's on their computer. So it's an easy promise. So the idea that lenders would get worried that the government can't repay and start refusing to buy bonds or charging a higher interest rate doesn't make sense in our story, right? They're risk-free assets, is what we'd say. Okay. And then from there, we would supplement that with a deep into the institutional details, the structures of how all these things work, to ask, is there anything at the institutional level that gets in the way of the story we just told about creating money and destroying money when the government spends in taxes, right? Are there any hiccups? Are there any holdups, right? We would say, let's look at how it actually works and what all the laws are, to ask, is there anything that can get in the way of this, right? And in the countries that we've looked at the US, we've looked at the UK, we've looked at another other countries, right? What we generally find is no. It turns out that when people build these systems, they're generally pretty smart, or at least they're responding to the needs that they're trying to fill, right? And the end result tends to be, what we find is that we have a system whereby if the Congress or the legislature votes to spend money, then money will get spent no matter what, right? There's all these institutional details happening in the background, in the US between the Fed and the Treasury and the bond markets and the primary dealers and all that stuff. And we could talk about some of it if you want. But those things happen in the background. The net result is, so long as the legislature votes to spend money, that money will get spent no matter what.
Again, just backing up to what you said about, are there any institutional barriers to the spending? Is there going to be anything to stop it? The article itself goes on to quote Dominic Cummings, quote, "We're going then to have to find emergency powers to tell the Bank of England to buy the debt." Like, that's not already been happening and can happen. So what he already knows, the power to create as much money as it needs to do whatever it wants, resides with the government, not with the Bank of England. The government is going to tell the Bank of England to buy the debt. So he already knows that that's where the spending emanates from. That's where the power emanates from. But he somehow doesn't put it together, with his headline concern.
Yeah, it's actually really funny if you think about it. It's pretty funny, that quote is pretty funny if you think about it, because he's saying, oh my God, we might not be able to spend the money unless we order them to spend the money.
Yeah. Exactly. Exactly.
Oh no. But I guess there's something else at play here. I mean, does their view of how things work rely, I think, correct me if I'm wrong, but on the perception that there is something special about reserves that is different about bonds, and that difference is crucial to the value of money itself. Is that the right way of looking at it?
Different how?
Well, they don't consider bonds to be money, first of all, and so they consider that the Bank of England is controlling the interest rate by controlling, in inverted commas, the money supply through basically adjusting the amount of reserves in the banking system. That to them, that is the money supply.
Yeah, that's true. If you look at like how the older money multiplier models, which thank God are being taught less often as the economics profession, even the mainstream is moving away from that kind of stuff. But the way those models work is that the central bank chooses a level of how much bank reserves there will be, what the level of the monetary base, and then you've got the multiplier process in the banking system, whereby like banks can multiply the size of their deposits by some, based on the required reserve ratio or whatever. It's kind of like intro money and banking stuff that I try not to get into because it's rubbish, and even the mainstream isn't teaching it so much anymore. But yeah, in that view, they set a level of bank reserves, and that's going to determine the size of the money supply and interest rates as well, or whatever, based on that. In our view, though, they don't do that. They don't set a level of bank reserves. What they do is they just set an interest rate, and then they provide whatever amount is needed to amount of reserves that banks need to go about their banking business, which actually is not very strongly tied to the interest rate anyway. Right? So sometimes you hear people say, "Oh, the central bank might have to add more bank reserves in order to lower interest rates." That turns out not to be true. There's this documented thing called the announcement effect, whereby all the Fed had to do was say, we're lowering interest rates, and interest rates would go down. They didn't actually have to do anything else, right? They didn't even have to add reserves. They didn't have to do anything. They just had to say lower interest rates, and then interest rates would go down, right? And that's because, market participants are paying attention. And first of all, they need a certain amount of interest rates. The Fed can't really give them less than that. And at least back the way things worked before 2008, they couldn't really give them more than that either. So there was a certain amount that, was going to be the amount regardless of what the interest rates was. But then also, the banks are paying attention, and they know you can't fight the Fed, right? That's a popular slogan. So the Fed wants lower rates, might as well just do it. No point in waiting for anything to actually happen. But anyway, so those are kind of some nuances of how central banking works. I don't know if you guys, how interested you are in those arcane details.
We are very interested, and the audience are very interested. You came to the right place. Nuance away, my friend.
Well, yeah. So the big picture here, I think, is that in countries like the US and the UK, right, when we do these institutional analyses, we find there is no hurdle. We could talk maybe about the debt limit in the US, which is a bit of a thing. But, for most other countries that don't have that one weird thing that we've got here, if the Congress votes to spend money, then the money's going to get spent, and they're not going to. And it's not even, the quote from that official said, we might have to order the Bank of England to buy government bonds. It's not even about that. It's not even like, and this is, some mainstream economists have this view sometimes that, okay, what would happen is that the Treasury would try to spend, they wouldn't be able to, so then they'd have to call up the central bank and force them to do something to let the Treasury spend, right? It doesn't even work like that. If the legislature votes to spend money, then the money's going to get spent, and there's no emergency measures or nothing. They're always working together, right? The Treasury and the central bank are always working together to make sure things work smoothly behind the scenes, right? There's none of this like, I think the mainstream economists have in their head that there's some kind of like wall of separation, and the people don't talk to each other, and they just go about their business as if they don't exist. It's not like that. Maybe that's true at the policy level or something, like the Monetary Policy Committee isn't talking to, whoever makes fiscal policy recommendations or whatever. And maybe that's true. I don't know. But at the implementation level, the people who are actually buying and selling the bonds, and the people who are, doing the adjusting the amount of bank reserves and those kinds of things, right? Those people are talking to each other all the time because they have to, because their actions affect each other. Yeah, they affect each other because, right, like think about when the government's spending and collecting taxes, right? Let's say, we tend to think over long periods like a year, but what if we're talking about like a single day, right? On a single day, they might spend less than they collect in taxes for the day, let's say. So they run a surplus for the day. And even if they're running deficits for the year, there's plenty of days in the year where they would run surpluses, right? And they would run bigger deficits on other days, so it nets out to a deficit or whatever. But if they run a surplus for the day, a cash flow surplus, then they're pulling reserves out of the banking system, because in the US at least, the way the Treasury operates is it's got an account at the Fed, right? And so when banks make payments to the Treasury, that's bank reserves leave the system. And so it's pulling reserves out of the banking system if it does that, if it runs a surplus for the day. Or if it runs a deficit for the day, it's putting bank reserves into the system that weren't there otherwise, right? And so the Fed then has to pay attention to that kind of stuff. They have to make sure that, monetary policy is still happening the way they wanted it to. Now, it's different depending on how the central bank implements monetary policy, and there's floor systems and corridor systems, and ceiling systems, and all this stuff. And again, I don't know what you guys want to get into or not get into, or some other people or whatever. But, so all I'm saying is these two institutions, the central bank and the Treasury, have to and always are working together to make sure that the two big policy things, fiscal policy and monetary policy, work out the way they're supposed to. And so there is no danger of, oh God, the government's not going to be able to spend, right? For a monetary sovereign, it doesn't work like that. Again, we can look at the institutional details in each country, and it could be the case that there is some legal hiccup, right? That maybe there's some law that actually, if we hit this condition, the Treasury might not be able to spend and the central bank might not be able to do anything about it, and, we could have a big problem, right? But countries tend not to write themselves into those kinds of corners.
Mm-hmm. And so this kind of brings us to you had a Medium post September last year, which could help us a bit further. It's called Saving and Investment by Degrees. And you talk about first, second, and third degree finance. Would you mind laying that out for us?
Sure. Well, the basic idea here is that when people think about saving and investment, right? Okay, so what I'm saying is that the concept that people usually bring to the table with those things is sort of backwards right from the beginning, and rethinking it a bit would help. And I'm not sure I'm saying anything revolutionary here. I think this is just sort of the standard post-Keynesian line or MMT line, but I'm maybe trying to clarify and put a few names to things, and that's really all I'm. But when people think about saving and investment, what are they thinking about? Okay, so investment, usually we think of businesses producing physical capital. So you produce factories, machines, tools, whatever, right? So physical investment, okay, that's what gets counted in GDP as investment, not financial investment, right? Buying a bond does not count as investment in the GDP numbers. We're talking about physical investment, okay, or productive investment. Saving, on the other hand, you'd think of as, you have money that you have spent less than your income, or usually the technical definition is you consume less than you produce, or you consume less than your income. So it's income not consumed is the definition of saving. Okay? And you do just a little bit of math with the GDP figures, because if we're doing this really simple version that ignores government and ignores foreign trade and all that, then, GDP comes from consumption and investment. Right? We produce consumption goods, we produce investment goods, and that makes up GDP. And where does GDP go? Well, it either gets consumed, right? We produce some fries and then we eat them, or it gets saved, right? And you can think of this as income as well, because GDP and income and output, all the same thing. So income gets produced from consumption and investment spending, and income either gets consumed or it gets saved. Whatever doesn't get consumed, we count as saved. So if you could see the algebra in your head here, on one side of the equation, you've got consumption plus investment, C plus I. On the other side of the equation, you've got consumption plus saving, C plus S. So you've got C plus I equals C plus S. So you got C on both sides of the equation, right? So you cancel them out, and now you've got I equals S, investment equals saving, right? So this is just like very simple macro accounting that you would cover at the beginning of your macro class. And you learn that investment equals saving. And how do you make sense of that? How do you make sense of investment equals saving? Because it seems like two totally different sets of people doing two totally different things. What is it that makes investment equal saving? Like, why should these two numbers be equal? One version of the story focuses on borrowing and lending, right? This is the more mainstream story. They would say, okay, the reason investment and saving have to be equal is because you have to borrow in order to invest, right? So if you're a firm and you want to do some investment project, you want to build a factory, you're going to borrow money to do that, right? That money that you borrowed has to come from somewhere. It came from the people who saved their money and then lent it out. And that's why saving equals investment. And what could happen if they aren't equal? Well, maybe interest rates would move around. So like, what would happen if there was not enough saving to do all the investment we wanted to do? So there's more people trying to borrow than there are people trying to lend. So interest rates get driven up. And so that gets rid of some of the borrowers who now aren't going to borrow, and then attracts more lenders. So interest rates move to make saving and investment equal, right? That's how that story goes. And I'm saying, and post-Keynes have been saying forever, since Keynes, that that's the wrong way to think about it. It gets the story backwards. It's not the case that we need savings finance investment, but rather what happens is that investment creates saving. So we look at the same equation, I equals S, and we say the causation goes the other way around. It doesn't go from saving to investment, it goes from investment to saving, right? And I think the easiest way to look about that, to get that, wrap your head around that, is to think actually in terms of what I kind of call these degrees of financing here, right? And again, because I was saying this earlier, ironically, the mainstream story privileges money. It treats money as kind of special. And money is this thing that you have to borrow in order to invest. And if you have it, then you can lend, if you've saved it, then you can lend it out, right? And you kind of can't do investment in this story without money, without borrowing money from somewhere, right? And I'm saying, first of all, that is obviously not true, right? Because what can you do if you don't have money? You just write an IOU to somebody. So this is what I call first degree finance. These aren't standard terms, but it's just what I'm using. First degree finance. You want to get a good from somebody, just write them an IOU. And this is actually widespread. We can talk about how consumers do it, but it's all over the place in the business world with something called trade credit, right? You get goods from your supplier, you write them an IOU, you settle it later at the end of the month, right? Accounts receivable and accounts payable and all those kinds of things, right? So businesses are buying stuff on credit by just writing IOUs without borrowing and lending money all the time, right? You could even think of it actually, workers are sort of doing that too. When you you go to work for the day, but you don't get paid till the end of the week, well, your paycheck's accruing, right? You're sort of getting paid for an IOU. The IOU settles at the end of the week. So it's on credit. So the money doesn't have to be there. And then second of all, well, what is money anyway? Well, again, in the MMT view, money's not special. It's just another kind of IOU that happens to be a very good, very liquid, very widely accepted IOU. So this is getting into what I would call second degree finance, right? Because if I want to buy some goods from you and I want to write you an IOU, now you have to worry like, okay, this guy's writing me an IOU, Sam's writing me an IOU. Is he going to be good for it? Right? Like, is first of all, you could think like, is that guy a scumbag? He's trying to rip me off or something. Okay. Even if I'm not a scumbag, you could be thinking like, well, where does that guy's revenues come from? Or, what business does he do? Is that business going to be successful? Is it going to be, is he good enough at business to make this happen? Or is the market, the environment he's trying to run this business in the right one for this business to succeed and for him to be able to pay the IOU? So you can ask those kinds of questions. But you might be worried that this is not I'm not willing to take this risk, right? This is not creditworthy. And so what you can do is instead of accepting my IOU directly, if I want to buy something from you, we can bring in a third party, bring in like an intermediary. And here's how that works. Instead of me writing an IOU to you, buy stuff from you, I write an IOU to the third party, to the intermediary. And then the intermediary that you trust and you think, we both agree we trust this person and they're going to make good, the intermediary writes an IOU to you. So I get the goods, the intermediary gets my IOU, and you get the intermediary's IOU. And so now this intermediary, this third party, can specialize, first of all, in making me pay, right? In finding me and breaking my legs if I don't pay or something like that or whatever. And then you can, you've got an IOU from someone that's widely trusted. You trust that they're going to make good, right? So then you don't have to worry about tracking me down. You don't have to worry about knowing all the details of what's going on in whatever market I'm in. That's the other person's problem. So I call this second degree finance. It's like a form of IOU laundering, right? You don't trust my IOU, so we launder it through this third party. They write an IOU to you. What is this intermediary, this third party? What are they called? They're called a bank. And the IOU that they write to you is called a bank deposit or a checking account balance, right? That's money, right? This is bank money. And so bank lending is money creation, and it is this second degree finance kind of transaction, this IOU laundering kind of thing.
That reminds me, I don't know if they had it in the US, but in the UK, as far as I know, until not so long ago, they had this, we use checks a lot more often a few years back, but people would often hold, like with their credit card or their debit card for their bank, they would have a sort of guarantee in the credit card that the government would guarantee checks from that person up to, say, £50 or something for small spending in a restaurant. And as a waitress, I used to receive these all the time. What the bank is doing there, tell me if I'm looking at this the right way. So the customer, by writing the check, is effectively creating money on the spot. an IOU, as you're saying, and the bank is simply guaranteeing that they will honor that IOU for the restaurant or whoever is receiving it. Exactly as what you're saying right now, right? That money didn't exist before.
Yeah, you create credit, right? Somebody's willing to accept an IOU. So you didn't need to have something in advance called savings or called money for the transaction to be paid for, right? You just write an IOU, right? And so, but going back to saving and investment, so therefore we'd think of the causation as going the opposite way, right? If I'm going to sell some, or let's say I'm going to purchase some investment good, I'm going to buy a factory or something, a new factory. Somebody builds the factory and I write them an IOU to build that factory, right? Well, that's investment. Where's the saving? Well, because there's no pre-saved money here, right? So what's going on in this story? Well, it's interesting. The people who have this saving, in the article, I call it a finding the money story in their heads. They look at that and they go, something's wrong here. Something's not right, right? There was no saving. Nobody saved the money. It was just created, or there was just an IOU written. So something's wrong. And in some cases, you'll get people saying this is a distortion, or this is a perversion, or this is disgusting, and we have to make it stop. It becomes a moral thing, right? Like credit is some kind of, I don't know, infringement on God or something like that. But right, because there's no pre-existing savings. You just why didn't, and sometimes you see people refer to this as genuine savings versus credit expansion, credit creation, or whatever. And so I'm saying, no, it's not a perversion, right? It's just that you got the savings part of it, the story, wrong. When you do the investment, when you produce the physical factory, that's the saving right there. Because what is the definition of saving again? It's income not consumed. Okay, nobody said it had to be in the form of money. So you produce a factory, that's income. That's physical income or real income. You've got more goods and services, more property than you had before, right? So your income's gone up. And you haven't consumed it because it's a building. It's not like you can eat it, right? Or at least, it hasn't depreciated yet or whatever. It hasn't been consumed. So income not consumed, that's the definition of saving. So producing the building itself is the saving, right? It's investment in that we produced an investment good, and it's saving in that it's income not consumed, right? This is the idea that investment creates saving, right? And then it can change forms though, because let's say, you produce this factory, you produce it. So you've got this saving on your balance sheet in the form of title to this factory. But then you sell the factory for my IOU. I pay you with an IOU, let's say. Now you're holding my IOU that's worth the same amount as the factory, right? Well, your saving is just as much as it was before. You still earned the same amount of income and you haven't consumed it, but now you're holding it in a different form. Instead of holding it in the form of a claim on a building, now you're holding it in the form of a claim against me, a financial claim against me, right? So the saving can change forms here, but it is the act of investment that creates the saving in the first place, right? There doesn't need to be some pre-existing pool of savings that we borrow from in order to finance the building of the thing. We just write IOUs, right? We do it the first degree, we do it the second degree where we launder the IOUs through the intermediary. It's the same thing though. The investment creates the saving, right? But what the people with the finding the money story are thinking is closer to what I would call the third degree of finance, which is where we launder IOUs, but we launder a pre-existing IOU, right? So you don't trust my IOU, okay, you won't accept it. So I need to get somebody else's IOU that you will accept. But instead of me going straight to that person, instead of me going straight to the bank, I go to somebody else who already went to the bank earlier, right? Or who already, for whatever reason, whatever happened, is holding those bank IOUs now, and I get the IOUs from them, and I give them to you, right? And so this is what we conventionally would think of as borrowing money, right? Or you can think of the bond market, right? I issue an IOU to somebody, another third party, but the third party is not the bank, but that third party is holding bank IOUs. They give them to me, so I've got the money now, and now I use it to pay you. Now you're holding IOUs against the bank, but we didn't get them directly from the bank, right? We got them, they were pre-existing out here. So this kind of third degree finance is really what the finding the money story people are thinking in their heads as the natural or base case. And I'm saying, don't think of it as, first of all, there's a few reasons why even that might not have something to do with saving, right? Just because they got the bank IOUs earlier in the story before this happens doesn't mean it's the saving that the investment equals saving equation is talking about. Anyway, even the third degree finance story is not quite what the finding the money thing people have in their heads. But either way, you shouldn't think of that as like the natural or base case. If anything, it's the first degree finance story that is the more natural base case. I just write an IOU directly to somebody to get goods from them, right? Is the more natural thing. And then the second degree and third degree are kind of like more complicated versions of that. But the end result is still sort of the same, which is I'm trying to purchase something and I purchased it. I wrote an IOU to somebody. It may not be the person I purchased the thing from, but somebody's holding my IOU. And meanwhile, the person I purchased the thing from is now holding an IOU from somebody. Maybe it's me, maybe it's my bank, whatever, but it's somebody that they're holding this IOU from, right? So the money, the bank money, really, I like in the third degree finance, it comes in like a catalyst. You guys know catalysts from chemical reactions, right? It's like a chemical it's not quite part of the reaction. It's not consumed. It doesn't like change form in the reaction, but it goes in. It's necessary for the reaction to happen, and then it comes out unchanged at the end, right? So in that sort of third degree finance story, the money comes in like a catalyst. The bank IOUs had to be there. They come in and they go out at the end unchanged. They're not consumed. They're not spent up. They're not used up or whatever. It's more like a catalyst. It's not like we're using scarce savings to finance investment. Mm-hmm. So even the third degree story is the closest thing to what these people have in mind, but even then, if you think about it more carefully through this IOU lens, it's still not the case that we need pre-existing savings to finance investment.
The way we've been talking about the way commercial banking interfaces with governments voting and spending money into existence recently is that, like we said before, when the government spends money, it doesn't have to issue bonds. That's a choice. But either way, it only spends one way. The money's voted into existence, and the Parliament or Congress instructs the central bank to change numbers on bank accounts. The reserve balances of the commercial banks go up, and then the commercial banks have to mark up the balances of the recipients. So the money is spent into existence. And then to simplify the endogenous money story, and I've checked this out with a couple of people in the last few weeks, it's fair enough. It's beyond dispute that banks are government agents in the money creation department. You don't just get to plug your laptop into the internet and say, right, I'm a bank now. Here's some dollars. So you can think of vertical money, as some people call it, government spending as money being spent into existence. And then you can think of commercial bank loans as the government through its agent lending the money into existence. Does that sound about right?
Yeah, I mean, that's certainly a decent way to think about it. It obviously gets blurrier because, banks lend, they do a lot of lending, but they also do some spending. They pay their employees and, they buy the building or whatever. So if they're paying people who have accounts at that bank, then they're doing the same kind of money creation thing. They're just marking up the size of a bank account in order to make a payment to somebody. And also, governments do a lot of spending money into existence, but governments lend to, central bank lends to the banks, and even the government, will like lend to small businesses and those kinds of things, or to, students, student loans, whatever. So the governments lend as well as spend. But yes, I think that's a good high level summary.
The other thing is that, I mean, this is a relatively recent thing, I guess, but that since the liberalization of the financial sector, banks now, at least in the UK, most of their income now comes from investment banking as opposed to from borrowing and from interest, from their borrowing and lending services. And so I'm assuming that in the US is a similar thing. To what extent would you just get rid of that whole kind of arm of banking that seems to have overtaken what banks were meant to do to begin with?
Yeah, well, this is a big conversation. Part of it is when we think of like the Jimmy Stewart kind of bank from, what's the name of that movie? It's a Wonderful Life. What that kind of bank did was it would make you a loan, right? A home loan or something. And then it would hold the loan and earn the interest from you. And then eventually you pay it down and that's it, right? So this is the originate to hold business model of banking, right? More recently, the last few decades, banks have really shifted towards the originate to distribute model of banking. They make a loan to you, right? A mortgage originator or somebody makes a loan to you, and then they sell the loan to somebody else, right? And eventually, it goes through the market and gets sold, who knows how many times, ends up in the form of like a mortgage-backed security that then some, pension fund owns a share in or something like that, or in some cases ends up being bought by the government. And, it's a more market-based finance approach as opposed to a bank-based or relationship-based finance. Now, I think the big argument for why people said we need a more market-based finance, we need more market borrowing and lending, selling assets or whatever, and selling, if you need to raise money, do it by selling bonds or selling commercial paper out in the open market instead of like go to a bank or a specific lender that and borrow money from that person or that institution, right? The reason we shifted to this more market-based model, the argument is something along the lines of, well, we want more capital, like we need more funding to happen, more financing, more saving to finance investment, right? And that this will make our financial system more competitive, that it'll make investment easier for companies to do, borrowing costs will go down or whatever, right? Maybe that's true, but it also has had some pretty terrific downsides in terms of like getting rid of the kind of relationships that help support these systems and keep them stable. So Minsky talked about this, like relationship banking versus this more anonymous market-based finance, right? If you have a relationship with your banker, they know you, they know what you're up to, they know what the market's like, they know, they have you have a relationship. They can make better judgment calls than maybe an anonymous market can. They can say, okay, based on the numbers I'm seeing on your paperwork here, things look bad. But I know you, I know you're good for it, I know you're going to work hard for it, and I know this market, and I suspect it's going to make it easier for you or whatever. And, in these kinds of relationship situations, even if the numbers look bad, your banker can say, I'm going to give you this loan, I'm going to help you out, we'll get through it together, right? The banker, first of all, knows you. Second of all, has more of a stake in your success, right? Because they're holding the loan that you've made them. So they want you to succeed. Where in this more market-based finance approach, it's anonymous, much more, right? You don't know. I mean, people get like, you ever see like people get things in the mail that are like, hey, we sold your mortgage to somebody else. So, you're with them now. And you get another one 3 months later. And it's like, who the hell is my lender? Who do I even write the checks to? So you don't know them. You don't have a relationship with them. If your numbers look bad on paper, they're just going to be like, we're done, cut it off, shut it down, right? Because they don't have an interest in getting to know you and figuring out if this is salvageable or not. The numbers tell them it's bad, so got to collect right now. And they have much less of a stake in your success because they'll just sell the thing to somebody else if it's not going well. They don't necessarily care about like what's going to happen 20 years from now. They care about short-term return. But it's definitely fed this kind of short-termism. So
okay.
Yeah.
So moving on, your most recent Medium post is to fight bullshit jobs, run the economy really hot. So you've recently read David Graeber's Bullshit Jobs. So I was thinking if you had time, give us your take on bullshit jobs and then tell us about your prescription.
Sure. So yeah, I read Bullshit Jobs, David Graeber. I think the full title is Bullshit Jobs, A Theory. And then, just as an aside, Graeber does this thing that I thought was awesome, which is where like the book is made up of like chapters with long titles and all these subheadings and sub-subheadings, and each of them has like a really long title. And I was like, man, this is bullshit that I'm reading these long ass titles. Like, the title structure of the thing like mirrors the thesis in the book. So it was great. Anyway, so the idea in the book is that there are all of these jobs that people have now that increasingly serve no function whatsoever, like do basically nothing useful for society. And the people who have them hate them and recognize that they serve no function. But not only that, they can't talk about it. Like they're compelled to pretend that they serve a function or to overlook it somehow or whatever. He also talks about sort of a more general bullshitization, which is like, even if your job is not bullshit per se, probably a lot of the things you do on your job are bullshit, like endless meetings or nonsense paperwork that serves really no purpose and we'd all be better off without. Somehow we have to do it. And so the book, he interviews a lot of people. He at one point solicited submissions of who, if you have a bullshit job, tell me about it. So he's got all, dozens or hundreds of stories that people are telling in the book. So it paints a pretty vivid picture. And he's got a whole taxonomy of what, like, that he creates of different kinds of bullshit jobs that are like half masters, flunkies, goons, duct tapers, right? There are these like colorful, like different kinds of ways that your job can like not contribute to society, or in some cases be actively harmful to society. Right. And so it's a very interesting book. And when he's talking about the causes of bullshit jobs, like why are these bullshit jobs proliferating? Why are they spreading? He talks about like, he kind of paints it as like a neo-feudalism kind of thing, right? Like what did the old feudal lords do? Well, they had wealth and power and status. And if you're going to have wealth and power and status, you have to display your wealth and power and status. And how do you do that? Well, what we might call today conspicuous consumption, but in the form of workers, right? You have people who are doing nothing, who are effectively actually wasting stuff just to show how powerful and wealthy you are, right? I'm so wealthy and powerful that I have all these employees who are actively wasting resources, and I can get away with that because I'm so wealthy and powerful. That's how you display yourself. So there's other things in the book besides that, but that's sort of the explanation he gives. And what I thought was interesting in the book, one thing that's interesting is he doesn't talk too much about how to deal with it, right? He says, this is a problem. Here are the contours of this problem. Here are the forms that it takes. He doesn't really give a lot about how do we solve it. And, that tends to be uncommon in books about a policy problem, right? You write a book about inequality, you write a book about poverty, whatever you're going to do. The last few chapters are usually like, and here's my 9-point plan for how to deal with it, right? That's common. But he doesn't do that. He does talk about like universal basic income for a little bit, and he thinks that would be a good thing to do, right? But otherwise, he doesn't give us too much guidance on what to do. And, there's some things that are obvious, right? Like the reason that capitalism is supposedly so efficient is because of competition. And so if businesses are creating all these bullshit jobs, then, it must be because of lack of competition. So we need more competition. So then we should have more antitrust or change antitrust or whatever to promote competition. I think that would be a mainstream response. And, we'd think about it maybe a little bit differently in terms of what antitrust is, but sure, I'm all for stronger antitrust, or I guess maybe in Europe you call it competition law. But yes, I'm absolutely for more of that. But one thing that I think is not obvious from the text, but I think would go a long way, and this is what I wrote the article about, is run the economy really hot. And maybe I'm a broken record, or I'm a one-track pony, and I always talk about running the economy really hot. Because when I've done the World War II stuff or whatever, if readers know some of the previous things I've written about the war, that's all about, it's World War II. We're running the economy really hot because we need everything we can get from the economy to fight this war, right? And in this article, I'm arguing, well, when you run the economy really hot, it forces some changes onto the labor markets, among other things. And those are changes that generally work against bullshit jobs. I mean, just from a very basic thing, if you're running the economy so hot that you've got shortages of goods, right? There's more demand than there is supply for, lots of goods and services, not just semiconductors, but all kinds of stuff, everything, right? Well, you can't really afford to have workers doing bullshit anymore, because any bullshit that they're doing, those are people and labor hours that aren't going into producing more to fill this demand, right? Think about during World War II, right? We can't have taskmasters and flunkies and goons and stuff because we need tanks. So any last person who is doing this bullshit, get them out of that and get them onto the assembly line to produce tanks so we can win this war, right? Like really wring the slack out of the economy.
Well, if I'm hearing correctly, like you mentioned UBI, and I think that's how I came to became acquainted with the book. But I've heard a lot of people who advocate UBI on the basis, often using the book as justification for it. But to me, what they're saying is that the existence of bullshit jobs must be because there isn't anything productive to do out there. If there was something productive to do out there, then surely they'd be doing it. And I think that's the wrong way of reading it, and I think that you might agree with me on that. But what your prescription to me is saying, counter to that, is no. If you want to get rid of bullshit jobs, make sure that your workers are doing things that are useful.
I would say I'd dive in there and say, yeah, what you're talking about, that phenomena of people going, yeah, we need UBI because all the useful jobs have been created because David Graeber's written this book called Bullshit Job, and guess what? The world's full of bullshit jobs. That I would argue, yeah, they've read the title. You know what I mean? And and they were like, that's me. I'm convinced. Yeah. Jobs are bullshit.
I'm sure he's a lot better than that. But
yeah, exactly.
Yeah. I mean, I'm not quite sure I don't think Graeber's really making that argument that there aren't things that needs to be done. I mean, you can think climate, you can think care, you can think healthcare, you can think just sort of general public services. There's all kinds of stuff that needs to be done. I mean, even in the private sector, right? Like innovation is slowed in the private sector. Like, why do our internet in our country, at least the internet is much slower than it should be. And, we aren't. So there's all kinds of work that does need to be done. So, no, I don't agree that there's nothing to do. But in some ways, you can think of that UBI proposal as a little bit of a mirror of what I'm saying, because I'm saying let's increase demand and therefore demand for labor until it outstrips supply. And so we have to start sucking workers from this bullshit into actual stuff that we need them to be doing, right? You could also say, well, what if we give people a UBI and make it so they don't need to work, so we decrease the labor supply, so it starts to fall short of demand, and so then workers that are still left in the labor force have to maybe get sucked into doing useful stuff as well, right? It's a little bit, you can think of it at least as maybe coming a bit from the opposite side, but, increasing production is generally better than letting it fall, right? We generally want living standards to go up. There's some nuance there about, emissions and the climate and all that, but generally we want more people to be working if they can and they want to.
In the piece that you write, to fight bullshit jobs, run the economy really hot, you cite another piece by Ed Nell called Capitalism, Socialism and Effective Demand. You got time to tell us about that, Sam?
Sure. So that is a piece that's from a book that is called Nicholas Kaldor and Mainstream Economics. So it's just a chapter in the book. I haven't read the rest of the book, but Ed Nell has done some absolutely brilliant work in terms of writing complex ideas very simply. It kind of reminds me of Warren Mosler. So like Nell's got a piece that we have read in a few classes here that's called The Simple Theory of Effective Demand. I would encourage listeners to check that piece out, or at least the beginning, not complicated part of it. And in this piece, Nell is looking at, he kind of calls them capitalism and socialism. And in some cases, I would say he is talking about capitalism and socialism, where socialism here really refers to like the Soviet economies, or, like the kind of centrally planned, that kind of thing. That's what he's talking about. But there's also, in a lot of ways, various things in the article aren't really about capitalism and socialism. They're just about, high demand and low demand, right? In Western economies, we tend to run with aggregate demand less than the supply capacity of the economy. So we could be producing more and we could have workers doing more stuff, but we don't, right? Demand is not high enough to, there's nobody to buy the things those workers would be doing if we just put them to work, right? On the other hand, in these centrally planned economies, it was almost always the case that actually demand was too high, that it was running above the capacity of the economy. So there were shortages because people are trying to buy more than the factories are physically capable of producing. So some of the article is specific to the centrally planned economies and to Western capitalism, but more of it is just generally about demand being high or low. And it gets into a bunch of different aspects. It talks about growth, and it talks about like the informal sector, and it talks about a handful of different aspects about these two different systems, or two different conditions at least. But the part that was related to this article was about how innovation works. He's making an argument that innovation in these two different kinds of systems works differently. In capitalism, it tends to work so as to divide up labor towards specialization, right? Towards machines that are built for a specific purpose, a single purpose, and workers that get very specialized knowledge of a specific job, right? That tends to be what innovation in capitalism does. And we've known that since at least Adam Smith, right? Who talked about division of labor as like the source of wealth in
his pin factory. Yeah.
Mm-hmm. Exactly. The pin factory, and how, well, one person couldn't build very many pins if they had to do all the steps. But when we split up the steps among different people, they're much more productive than they would be if each one of those people was just making the whole pin by themselves.
Yeah, but they might be more miserable. I mean, he did.
Which is exactly what he said. Yeah.
Yeah. So there is the quote, and let me close the tab. But it's something along the lines of that. Yeah, this is from Adam Smith, that he said the division of labor will like make humans as stupid as it is possible to become, or something along those lines. Because you're only paying attention to your narrow thing. You can't see the big picture, right? First of all, you just don't understand what's happening in the world outside you, and you only start to really internalize the concerns of the thing you're doing, right? So you kind of lose the ability somewhat to take other people's positions and see it through their eyes in a more general sense. But then also, right, it's repetitive, right? You don't get to do complex problem solving. You don't get to do critical thinking and integration work. You just do your one thing over and over, right? And so it makes people stupid and miserable. But, it makes us things more efficient, and we get all these wonderful things that capitalism has given us, and yada, 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 right? So that's innovation in capitalism. And Nell says that innovation under these socialism systems, or really he just means high demand economies, takes a different form, because the reason that you innovate in capitalism is to outdo your competitors to capture a limited market share. There's only so many customers, so you can't, if you make the next thing and it's not as good as what your competitors are doing, there will just simply be no one to buy it, and you will have wasted your time and money because there's only so many customers. Demand is not high enough to purchase everything that gets produced, potentially. In this shortage economy, this high demand economy, on the other hand, demand is actually too high. The market will take literally anything you've got to sell, no matter how good or bad it is, even, right? Low quality stuff, whatever. Demand is high. We need it. We'll take it. There's shortages. And so innovation takes on a different character, because the challenge is not to maybe beat out competitors for limited market share. The challenge is, how do I get this job done, even though I don't really have the resources available to make it happen, right? I don't have enough workers, and I don't have enough tools and equipment and raw materials because demand is too high and we've got shortages. So Nell says innovation under those circumstances looks a little bit different. What instead of splitting things up and dividing things and specializing, you combine things and you multiply them and you generalize, right? And you diversify or improvise, right? Like, because I've only got so many workers and there's a worker shortage, I can't get more. And in fact, there's a worker shortage, so I might lose these workers at any time and not be able to replace them. So it's a lot better for me. I can't really afford to have each one of them doing some special thing that nobody else knows about, because then I lose them and I'm screwed, right? What I need is everybody to be able to do everything, because that way, when somebody doesn't show up to work or whatever, we can still make things happen. And, whatever. So it's just, you get this effect of broadening people's view, and innovation takes on more of this resource saving character. Right? We've only got one worker, so we got to train them to do everything. Or we've only got enough metal to build one tool, so that tool has to be able to do all kinds of different stuff, right? Because we can't be building all these different tools, one for each step in the process, right? So this is where I get in the article. I think a useful metaphor for this is a pineapple corer, those machines that are designed to cut open pineapples and take out the core or whatever, versus a Swiss Army knife. Yeah. And I did have a few people misinterpret this and say, like, are you trying to say, like, we shouldn't have pineapple cores? And like, no, that's not what
I'm saying. Stalin.
Exactly. No, I'm not saying that. I'm just trying to. It's
what's
an
next? The gulag?
Yeah, right.
No, but you in the article, it's the great illustrations, I think, or the pictures that you picked. The Swiss Army knife being what we'd expect to see, but the pineapple core that you picked is like, it looks like a Rube Goldberg machine. There's just so many different angles and attachments to it, and it's just doing this one thing, which is taking the, core. Yeah, totally. So yeah, I think when you see it with the pictures, it brings it home. But yeah, it's what the internet's like now. It's just like totally. Posting anything on the internet is like, hey everybody, please misinterpret this. Here it is.
Can I just say something about what you've just said? Because a lot of bells were ringing in my head when you were saying, and a lot of things made sense to me immediately. I think what you're saying with the kind of the socialist innovation drive is that necessity is the mother of invention, if I'm not mistaken. And yes. I remember when I was growing up in Peru, a lot of the messaging from the government to try and instill some kind of pride in the population that was very lacking at the time was to highlight that despite all the economic difficulties that the country was having, that Peruvians were rich in creativity. And what they were referring to that was the fact that even though I'll give you an example. We had such severe shortages that sometimes local councils couldn't even find appropriate tools for cleaning. So a lot of councils and workers that were hired to clean streets and things like that would use palm tree leaves, that the long thing, massive thing that uses that looks effectively like a huge flexible broom. And we use that to sweep streets really effectively, I might say. And they would give things as that as example that we were inherently, a wealthy kind of country in the sense of that we had creative people and all this potential, but we were just going through hard times. And that just kind of resonated with what you said on the we weren't a socialist country at the time, but resonated with the effects of what you were describing. The other thing is that when you mentioned the capitalist way of innovation, and I think I mean, people latch onto that as to say, well, capitalism is better because, this idea that, well, through competition, we get better services and it leads to more riches and all this, whereas socialism is just so inefficient and blah, blah, blah. But in capitalism, as you say, you only need to overcome your competitor. That's the sole kind of incentive for you to innovate. But that innovation doesn't necessarily go into the goods or services that you're producing. It might go, and often goes, into just a better marketing campaign, or it might go into a lot of lobbying of key politicians to bend the law slightly in your favor, and there is a lot of competition on that area as well within companies. Or it might go into just trying to very sneakily gain market share without actually having to improve the service that you offer. So this idea that capitalism is more efficient because of that, it just doesn't ring true.
Yeah, and there's actually, I didn't put this in the article, but in that Nell piece, there's a little bit about how in capitalism, the sins are sins of commission, people committing things, doing things, like taking deliberate actions that are harmful, whether it's polluting the environment or whether it's cheating people or, fraud or kind of this harmful persuasion and advertising and stuff, right? Sins of commission. Whereas he says in socialism, the problems come from sins of omission, omitting things, not doing things because we don't have enough resources to get it done. So we just leave things unfinished, leave, corners cut because we couldn't manage it, right? So that's another, I think that rings true for that contrast with you're talking about. And maybe I should clarify that I'm as much as I talk about this like hot economies and shortages all the time because I'm so interested in the topic, I am absolutely not saying that we need like a long-term shortage economy, right? Like nobody wants decades of shortages, and I'm not in favor of that. What I'm saying here is we've got this specific problem that has built up of these bullshit jobs that have been proliferating, and to wring them out of the economy, one thing we should look at is tightening our needs, right? Like wringing the slack out of the system by raising demand, creating some of these conditions, putting pressure on these situations until they're not there anymore, right? Or at least, down to a tolerable level.
It's almost like a progressive shock doctrine.
I guess it's the opposite of shock therapy, you might say. I mean, it's a bit of a divine coincidence, right? Which is like at the same time that we need, people to really work on solving the climate issues, we also have these bullshit jobs that need to be dealt with as well, right? So it's not sort of just for fun, but I think it would help.
I was going to say it rhymes with that speech that Warren Mosley gave a few years ago in Italy about, he opens up by saying, let me just start by saying what a good economy is, because you probably need to be as old as I am. Warren was back then. You need to be as old as I am to know what a good economy looked like. And it's one where firms are competing for workers. They're trying to create better conditions to attract workers. They'll start paying you before you leave school. They'll start training you before you leave school, and and that's what he could remember. So we're not talking about like
that's what labor shortages look like. And I guess I want to add, like, because Patricia, you were talking about like people praise capitalism as like delivering these goods and it's efficient and all that, and sure, but you always have to ask good for whom. right? Like an economy can only do so much, right? Some people have their needs and their wants filled, and others don't. And that's not the same thing as like scarcity, but it's to say, our economy it necessarily prioritizes some things over other things. So running demand too low, right? So that we always kind of have these, I guess you call them surpluses or excess capacity, is good for consumers. Consumers get choices, right? An analogy I like to use here is think about snacks on an airplane. Okay, so you go on an airplane and they walk up the aisle and they like what kind of they ask what kind of snack do you want, and here are the choices or whatever, right? But it's an airplane, and so they're where do the snacks come from? Well, they put them all on the plane before the plane took off, right? And they're pulling from the spot where it's stored. But what happens when they get to the last row and the person says, I want this snack or whatever, and they right? Well, they've got to still have some of that left for that guy to be able to make a choice, right? For the airplane to allow customers to make the choice after the plane has left the ground, that necessarily means they have to take extras of everything because they don't know what you're going to choose. So they have to be prepared for whatever, if they want to be able to serve everybody, to give everybody the choice, then they have to have extra of everything. And so most of the time, they're going to land, they'll finish the snacks and they'll land and they'll still have extra. Right? It's carrying extra snacks of all the different kinds of snacks all the time, right? Now you can imagine instead, if we didn't care so much about consumer choice there, if we kind of said maybe something else is more important than consumer choice, whatever it is, maybe we just don't want to have extra food all the time, whatever that might be more important than doing that. Well, then what if they took orders on the ground? Before we leave, tell us what kind of snack you want. And then we will pack exactly the right, right numbers of each type of snack so that on the plane you get exactly what you ordered, but then you can't change your mind, right? We don't have any extras. You can't choose a different one later, right? So if we really care about consumer choice, then we necessarily have to have extra stuff lying around. Whereas if we really cared about, not having extra stuff and not wasting the space or wasting the, plane's weight capacity or whatever it is, or not wasting the aircraft service people's, I shouldn't say wasting, but not using their time to take all these orders on the flight. But then we don't get the consumer choice.
Yeah.
Our system, when demand is low, that enables us to have this consumer choice because consumers can make whatever choice they want whenever they want. And we have enough excess capacity to just give it to them, right? Whereas in these kind of shortage economies, high demand economies, it doesn't work like that. You can't make those kinds of consumer choices because the capacity is not there, right? You go to a restaurant and they're full all the time, and there's no room for you to just slip in at the end. You can't choose late, right? You have to have made a reservation early or gotten in line or whatever. That kind of consumer choice is curtailed. But what do we have instead? Well, we have like high wages for workers, right? We've got a labor shortage, so wages go up. So that kind of economy like prioritizes worker well-being over consumer choice, right? And I don't know that I want to make a judgment about what is the best kind of world to live on. I would prefer to say we need to balance these things against each other, right? High demand economies are good for workers, and lower demand economies, can fill more consumer needs, if they're structured to do that. It's not that simple either, but yeah, you guys get what I'm saying? It's just about who is our economy built to serve? What is its highest priority, and what things are lower priorities, right?
And on that as well, I mean, that there's a ton of studies that out there that to start looking at, what the effect of choice is, because if you're saying, if I'm hearing correctly, if in the capitalist economy you have, as you say, more choice, but only a few people have more choice. Some people don't have much choice in terms of the employment that they have or the wage conditions that they have.
Yeah, so so if we forget that workers are consumers too, and we make life worse for workers, and then the consumers hurt on the other side of that. So yeah, absolutely.
But the other thing I wanted to know, I heard this. I've read a lot about creativity, and you mentioned something that in capitalism tends towards kind of efficiency by specialization, and that curtails workers' creativity, their happiness, and etc. And whereas as in socialism, it may be less efficient in inverted commas, but it would also lead to happier workers. And so in the socialist system, if a worker then has kind of more power, more autonomy over the work they're doing, they're not kind of alienated from their work as they are with the capitalist system, would that then contribute to better innovation, you think?
Well, again, I don't like Nell's article is some of it is specifically about centrally planned economies, but I don't really want to draw a broad brush with socialism because different real world socialist economies have worked differently, and what people more modern social movements, when the left, when we say socialism, tends to mean something different than that, and so I don't want to paint too broad a brush there. But I will say that I think in general, over specialization absolutely dims creativity and makes people unhappy, and making somebody's job a little more integrated so they can work on the big picture and see the big picture is good. It's also true that like people tend to if your job is to enrich somebody else, right? You're working at a company whose sole mission is to make profit for somebody else, and especially if you do that in a way that's socially destructive, right? You're scamming people or whatever, right? That tends to make people pretty unhappy too. We would much rather, if we're going to work at a job that's purpose is to make money for somebody else, we'd at least like the byproduct to be socially useful. But even better would be a job that is not enriching anybody unnecessarily, and it's just contributing to society, right? That's, I mean, people have all kinds of different personality types or whatever, but most people want to find meaning in their work, right?
That said, it looks like, from over here looking at the States, there's a lot. There seems to be a lot of positive things going on. There's a lot of regressive politics going on over there as well. But there's a lot. I see a lot of hope over there. But I was just to round off, I was just going to ask you, Sam. What's giving you hope right now?
Well, I'm a generally pretty optimistic person, although I got to say I've been more pessimistic the last year or two than I would normally be disposed to be. Personally, I sort of see this country in a race against fascism right now.
Yeah.
And I guess I'll say the things that make me optimistic are, at least it's the same thing that's making most people optimistic around here, which is the vaccines are working and the virus is becoming less of a news story here. And businesses are opening and returning to in person, and people are starting to go about their lives. And fiscal policy has been supportive and hopefully will remain so. We passed our big $2 trillion COVID package, and that money it's been supporting the economy. And you see here, people have had money that they've saved and that, they're starting to spend, or they've, paying down debt, or that stuff is working. And, I've actually got just the people I live with are seeing the effects because they work in restaurants, and they're seeing what the labor shortage that's happening here in restaurants is like, and that is slowly going to change the way people think, I think. It hasn't quite dawned on people yet. This is a learning process. It takes time. But imagine living in an economy where the boss needs you more than you need them, right? Nobody my age can remember that. And even people a decade or two older than me can't remember that, right? Living in a situation where the boss needs you more than you need them, right? So that gives you some bargaining power, right? So I'm seeing some of my friends start to realize that and start to explore that. So that's giving me some hope. But, if we don't keep it up, if we don't keep the economy strong and keep up the fiscal support, then, like I said, I think we're in a race against the fascists here.
Yeah.
So I think the infrastructure talks they're doing, it is absolutely critical that they get something and big and fast, and that we do it, and that it makes a real difference, and that they sell the crap out of it so everybody knows who did it, knows who made their lives better, right, and knows who to vote for at the next election, because the alternative is just getting worse and worse in this country.
Yeah, I totally agree. And I think we've said this before a few, 2 or 3, 4 guests ago. We absolutely should not give Biden the credit for being progressive. He was dragged into progressive land by people further to the left than him. He needs to do more. He didn't act fast enough. And, he's still pretty terrible on the imperialism front as well.
Yeah, there's always a lot to complain about. But you know what? I don't know. I don't know if it's right to say my standards are lower, or if it's more just to say I'll take anything. But
yeah,
I'll take it. If they they get a package done and it works and it helps people, and then we vote some of the fascists out and reject that next election, then I will feel a lot more comfortable, I think.
I think for the sake of your own stress levels, you should go, well, this may not be amazing, but it's good enough for now, especially because the alternative is so much worse. But at the same time, I hope that progressives in America are still kind of pushing and saying, reminding Biden that it's still not good enough. It may be better than what was on offer a few years back, but it's still not good enough. Keep pushing.
Absolutely right. But you know what? I mean, people are organizing, and I think COVID forced a lot of people to organize in ways that they maybe even hadn't considered before. Like I heard a lot of people starting to form like tenants unions and things like that, right? Because, COVID and suddenly you don't have a job. So how do you deal with your rent? Okay, let's get the tenants together and we got to deal with this, right? Or there's like in Kansas City here, there's like a homeless union that formed, right? And so they're like going to city meetings and we're saying like, we're the homeless and here's what we need. And here's, we're not going to take it anymore. And so people are organizing and they're doing it in ways that are grassroots and surprising, I guess. And it's exciting. And I'm hoping also, I think I've been into politics forever, but I think a lot of young people that maybe thought they could ignore the stuff and pay attention, all the stuff in this country, COVID, January 6th here, when they stormed the U.S. Capitol and trying to steal the election and all that stuff. I think I'm hopeful that a lot of young people are going like, oh my God, this is really important and I can't check out, So yeah, I'm always hopeful, but for a while I was saying that I was pretty sure it was going to get worse before it gets better. And I think it did get worse. And now I'm hopeful that it's going to get better again, but boy, is it a close race.
Yeah. Well, look, I think that's a great place to leave it. Sam, it's been a joy as ever to talk to you. We're going to link to all things Sam in the show notes. And so thanks for joining me and Patricia once again on the MMT podcast.
Thanks for having me. It's my pleasure to be here.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.